It was 3:07 p.m. on March 12 when I sent a $12,500 Apple buy order, but the confirmation from my broker only showed $9,375, just 75% of the sum. Where did the missing $3,125 disappear to? I rang the broker, got a non-committal shrug, and was told the trade was routed to a dark pool. Simply put, a dark pool is a private venue where big-wig traders hide their deals from the public. That evening, a lone line in my spreadsheet marked the $3,125 as vanished into a black box venue, never landing on the NYSE floor I could watch. Next morning, a buddy, an independent quant known for his hobbyist flair, shot me a screenshot of a dark pool feed that recorded a matching $3,125 trade just seconds after mine. He told me, "Your order got siphoned, and you didn't even know." I stared at those numbers, my heart thudding. If a lone $12,500 order can shed a quarter of its size, what does that say about the millions of retail traders who assume their orders land exactly where they think? The answer: a hidden, systematic drain that could be gnawing away at a huge slice of everyday investors' portfolios. The screen flickers to a red line chart, a jagged line where retail volume dips right as dark pool activity spikes. 25% of retail trades rooted off exchange. The story isn't a one-off glitch. It's a pattern, and I'm about to pull back the curtain on how algorithmic tools are letting retail traders copy the very smart money moves that used to belong only to hedge funds. We'll uncover why a quarter of every retail order might be slipping into a secret ledger, and what that means for your next trade. Close up on a blinking cursor as a code snippet runs, parsing SEC filings. I've spent the past 5 years dissecting market microstructure, chasing every breadcrumb the SEC, courts, and investigative journalists drop. The data line up, and the stakes are staggering. Retail order flow made up 25% of total equities volume in 2021, with 92% funneled to just 4 off-exchange market makers' spots where transparency is thin at best. Source: SEC Staff Report, 2021. That same report points out that pool venues now handle a sizable chunk of that flow, effectively acting as a black box for a quarter of retail trades. Graphic of 4 market maker icons, each swallowing a slice of a pie chart. Enter the new wave of algorithm-driven retail tools. A peer-reviewed study shows algorithmic retail trading systems now account for 18% of total market-making activity, tightening spreads but also amplifying volatility when markets get stressed. Source: SSRN Paper, 2023. These systems aren't just crunching numbers. They're learning the playbooks of institutional traders, reverse engineering order routing tricks that used to be proprietary. Voice over tightens, urgency rising. One of those reverse-engineered traders is a pseudonymous figure Bloomberg dubs the Godfather, who built a system that parses public SEC filings and leaked dark pool data to anticipate where institutional orders will land. Source: Bloomberg, 2023. He didn't need insider tips. He used publicly available info, fed it into a learning model, and let the system pick the optimal route for his own orders, often beating the big guys at their own game. A stylized silhouette of a hooded figure over a backdrop of code. But why does this matter to you? FINRA reports $3.8 billion in revenue from payment for order flow, PFOF, in 2022 alone, highlighting a structural conflict. Brokers get paid to hand your order off to entities that profit from the very trade you thought was yours. Source: FINRA Guidance, 2022. When those entities are dark pools, the opacity means you can't tell if you're getting a fair price or being subtly short-changed. $3.8 billion in PFOF revenue. Who's really paying? The stakes get personal when you examine the prosecution of former Goldman Sachs trader David Weiss. He was sentenced for front-running retail orders via dark pool routing, a case that exposed how payment for order flow can create outright conflicts of interest, letting a few insiders skim off the top of retail trades. Source: U.S. Attorney's Office, Southern District of New York, 2023. Courtroom sketch of Weiss, a gavel slamming down. Put those pieces together. A quarter of retail volume is funneled into opaque venues. Algorithmic tools are now giving individual traders the same routing intelligence once reserved for big institutions. And the very system that promises free trades to you may be the same one siphoning a chunk of your order away. A flowchart shows retail orders entering a broker, splitting into public exchange, 75%, and dark pool, 25%. So the question that keeps me up at night is simple. If 25% of your trades are disappearing into dark pools, how much of your portfolio is silently being eroded? The narrator leans in, voice dropping to a conspiratorial whisper. In the next minutes, we'll walk through the exact mechanisms dark pools use to route orders, how algorithmic tech is turning the tables, and what you can do right now to protect your trades from becoming phantom assets. Countdown timer appears. 0:02:30. Stay with me. The truth is about to surface. So you tap buy on your phone, right? You figure you're just placing a simple order straight to the exchange. But here's the thing. That one tap, it kicks off a whole chain reaction of code and calculations no one ever sees. Your order isn't just getting sent out, it's being sniffed over, sized up, and handed off based on what some giant institutional player might be doing next. Maybe it's slipping you into a dark pool where trades happen in secret, or maybe it's being pawned off to a market maker who's already been paid to take your order, all invisible to you. But here's the wild part, the data. It's pretty shocking. All right, let's dig into the AI that's tracking the big players' moves. High-frequency trading firms. They feed every little wiggle from the NASDAQ and NYSE order books into machine learning models. These models are basically trained to recognize the fingerprint of a hedge fund going all in on a stock. They look for three key clues: orders bunching up in size, timing that screams institutional, and those sneaky iceberg orders, tiny slices that hide a massive parent order. When the AI flags one of these institutional footprints, it makes a routing call in the blink of an eye. A 2022 study out of SSRN found that AI-driven retail trading now makes up roughly 18% of all market-making activity. That tightens spreads, sure, but it also cranks up the volatility when things get rocky. Source: Now why should you care? Because the same AI that's spotting the big players is also deciding if your order ends up on a public exchange or shoved into the shadows of a dark pool. Dark pools are these private backrooms where trades happen away from the prying eyes of the public order book. Sometimes you get a price that's a fraction of a cent better than what's on the screens. But here's the kicker: that better price, it's usually paid for by a hidden rebate to the pool operator, and that money, it's coming out of your broker's pocket, not theirs, and it's not random. A 2021 SEC report laid it bare. Retail orders made up 25% of all equity volume that year. But get this, 92% of those orders were funneled to just 4 off-exchange market makers. Source: These 4 firms. They're raking in the cash from payment for order flow deals, and they've got every reason to keep retail orders out of the lit market where prices are fair and transparent. Real-world examples show just how deep this rabbit hole goes. Back in 2022, the feds prosecuted a former Goldman Sachs trader named David Weiss. Turns out his crew was using dark pool routing to front-run retail orders. The algorithm would spot a wave of small retail buys, then blast a bigger order into a dark pool to get filled before the little guys, pocketing the spread before the market even had a chance to move. Source: the court didn't beat around the bush. This wasn't some rogue operation. It's how the system's rigged. Here's another wild one from Bloomberg's 2023 deep dive. A retail trader nicknamed the Godfather reverse-engineered how market makers were routing orders using SEC filings and leaked timestamps. Then he built his own AI bot to mimic the flow, slipping into the same dark pools before the big orders showed up. The result: a steady stream of micro-price improvements most retail traders never see. Source: so how do these payment for order flow deals actually work? Let's say you're using Robinhood or E-Trade. They cut a deal with a market maker like Citadel Securities to sell your order flow. In return, Citadel pays them a little kickback per share. The SEC's FINRA data says this added up to $3.8 billion in 2022 alone. Source: that money shows up as revenue on the broker's books, which is how they can brag about commission-free trades. But here's the catch: it creates a conflict. The more shares the broker sends to the market maker, the more they earn. So there's a built-in incentive to route orders where the payout is highest, not where you, the trader, get the best deal. The SEC's got a rule about best execution, but when trades vanish into dark pools, no one can really check if you're getting a fair shake. When your order lands in a dark pool, the price you get is usually the midpoint between the best bid and ask at that exact second. If the pool offers a rebate that offsets even half a cent of the spread, the broker might call it good enough. Meanwhile, a lit exchange might have filled your order tighter after the spread tightened. That's why studies keep finding retail investors get an execution quality a few basis points worse than the market average when their orders get funneled to dark pools. Let's crunch some numbers. Say you drop a $10,000 market order for 100 shares of XYZ. The NBBO is $100.00, $100.05, so the midpoint's $100.025. A dark pool fill might land you at $100.02, giving the broker a $0.005 rebate per share. That half cent looks tiny, but multiply it across millions of trades. It's serious cash. On the flip side, a lit exchange could have filled you at $100.01, saving you $0.01 per share. That's twice the rebate but half the cost to you. Over time, that nickel and dime difference adds up, especially for day traders who fire off dozens of orders every day. This isn't just theory. The SEC dug into execution quality in 2021 and found retail orders routed to the top 4 market makers had an average price slippage of 0.3% compared to the best lit exchange price. Sounds small, but on $10 billion in retail volume, that's $30 million in extra costs every year. Source: so why do brokers keep doing this? Beyond the obvious cash, there's a regulatory loophole. Because these market makers are qualified under the SEC's broker-dealer exemption, brokers can claim they're meeting best execution duties without ever showing the fine print that reveals the real cost. The system's set up so the incentive to chase rebates outweighs the drive to get you the best price. It's a rigged game where the house always wins. What's AI's role in all this? These models don't just route orders. They predict which dark pool will offer the juiciest rebate based on past flow patterns. They'll also spot when market stress is about to widen spreads and hold your order back until conditions improve. In practice, it's a constant tug-of-war. Maximize broker revenue or minimize your execution risk. More often than not, the algorithm picks revenue because the payout's immediate, while execution quality is something regulators only check in once in a blue moon. Here's the rundown for this block. 1. AI models gobble up institutional order flow signals and decide in microseconds whether your retail trade goes to a dark pool or a lit exchange. 2. Prosecutions and deep dives show dark pool routing is routinely used to front-run retail orders, skimming value before the market even reacts. 3. Payment for order flow deals print billions in rebates, creating a structural bias that nudges brokers toward dark pools, often at your expense, even if it's just a few pennies at a time. Now you've got the playbook. Next time your free trade fills a fraction off the public quote, you'll know exactly which invisible hands pushed it there. The next part's all about how to spot when your broker's shuffling you into the shadows, and what you can do to keep your orders in the light. You figured you were just tapping buy on your phone, right? Imagine an unseen engine slipping a quarter of each of those orders into a hidden tunnel. That isn't a sci-fi twist. It's the hard-won numbers the SEC laid out in its 2021 Market Structure Report. Retail orders accounted for 25% of total equities volume, and an eye-popping 92% of those shares were funneled to just 4 off-exchange market makers. How does that happen? Think of a sprawling highway where most cars are forced onto a private toll road you never see. The toll is the payment for order flow fee that brokers collect from those market makers. FINRA reports that in 2022, those fees generated $3.8 billion. That money isn't a charitable tip for your broker. It's a built-in conflict of interest that lets market makers, many of them hedge funds, skim the spreads before your order ever reaches the public exchange. Enter the hidden routing algorithm. It isn't some mystical black box. It's just a set of rules baked into the broker's order management system. When your trade lands on the broker's platform, the software scans a list of preferred venues and then quietly steers your order to the dark pool offering the highest payment. The outcome: 1 in 4 retail trades never see the lit market. Now, who's pulling the strings in those dark pools? The court record from the Southern District of New York shows a stark example. David Weiss, a former Goldman Sachs trader, was convicted for front-running retail orders by strategically routing them through a dark pool he helped manage. The prosecution laid out a playbook: receive the retail flow, execute a hedge fund order a split second before, then let the retail trade fill at a worse price. It's a classic Q jump that leaves you paying the premium. Source. And they're not doing it alone. Multiple hedge funds have teamed up, sharing data feeds that reveal when and where retail orders are about to be routed. By pooling that intel, they can anticipate the flow and position themselves a beat ahead. Think of it like a coordinated flash mob that knows the exact moment the spotlight will hit you, except the spotlight is your trade, and the flash mob is a network of high-frequency firms. You might wonder, what does that cost me? The damage isn't measured in a single headline number because the SEC never publishes a precise loss figure, but the mechanics are clear. When a hedge fund gets ahead, it widens the spread you pay, erodes the price improvement you'd otherwise get on the lit exchange, and can even trigger adverse selection losses during volatile moments. In practice, that means retail traders collectively lose millions in foregone price improvement every year. Source. Even the rise of AI-driven retail algorithms hasn't leveled the playing field. A peer-reviewed study found that AI-powered retail trading accounts for 18% of total market-making activity, which does tighten spreads in calm markets. But during stress events, those same algorithms amplify volatility, giving hedge funds even more room to skim the edges of the order book. It's a paradox. The very technology that could empower you also feeds the same system that hurts you. Source. There are rebels, though. Bloomberg's investigative piece profiled a retail trader dubbed the Godfather, who reverse-engineered hedge fund strategies using publicly available SEC filings and leaked dark pool data. He didn't have insider access. He cracked the algorithmic playbook by stitching together the same documents that regulators publish. It shows that the data isn't a mystical secret, just a puzzle that most retail investors never bother to solve. Source. So what does this all mean for you, the everyday trader? First, recognize that a quarter of your orders are silently rerouted to venues that prioritize payment over price. Second, understand that hedge funds are systematically exploiting that tunnel. They're not just lucky, they're engineering the flow. And third, know that the financial hit shows up as higher execution costs, reduced returns, and a market that feels rigged when you glance at your trade confirmations. The takeaway: the next time your broker promises best execution, ask yourself, best for whom? The answer isn't the public exchange. It's the dark pool consortium that's been cashing in on your trades for years. Stay tuned, because we're about to pull apart the very code that makes this happen and show you how to dodge the tunnel altogether. So we pried open that dark pool black box, and what we uncovered isn't just ugly, it's a rigged system that hurts everyday investors. The SEC's 2021 report pulls back the curtain. A quarter of every retail trade never even touches the public exchange. Instead, those orders get funneled to just 4 dark pool market makers. That's not competition, that's a funnel. And here's the kicker: the more retail traders lean on apps that sell their orders for a few pennies, the more those pennies stack up in fines, like the $3.8 billion FINRA collected in 2022 from payment for order flow. That isn't a fee, it's a kickback. Beat text pop, it means your broker could route your buy order into a dark pool where a high-frequency desk front runs it before you even press confirm. David Weiss, a former Goldman trader, was sentenced to 30 months for exactly that behavior. Front-running retail orders isn't a glitch, it's baked into how the system works today. Now things get weird. AI was supposed to level the playing field, right? Not so fast. Peer-reviewed studies reveal retail algorithms now account for 18% of market making. Yet during market stress, they don't calm things. They actually crank up the volatility. They amplify it. The same tools that let an anonymous trader reverse engineer strategies from public SEC filings can be hijacked by hedge funds running even faster bots. So what can a retail trader do? Beat tonal first, demand transparency. Dive into your broker's order routing disclosures. Every U.S. broker has to post them. Second, use tools that display real-time dark pool prints. Third, spread your trades across different execution venues. Don't let a single dark pool dictate all your fills. And if your broker won't reveal where your orders went, that's the answer right there. The market isn't broken, it's been gamed. But remember, knowledge is power. Grab the free dark pool checklist in the description. It walks you through the exact steps to spot conflict,